presentation to just give a little bit more about himself, and then we can open this up for a discussion.
Well, great intros from all y'all, and it's good to see a couple of familiar faces. Alan, I think I've been on your podcast at least 2 or 3 times, so that's cool to see you here. Arn, we've never met, but I recognize you from comments in the Bigger Pockets forum threads. I see you in there pretty frequently, so it's cool to put a face and a voice to all of the notes I read on there. And uh,
Well,
and
yeah,
Chris,
thank you.
yeah, absolutely. And Chris, good to meet you. We have a little bit of a shared background in a sense. I was in municipal law enforcement, not federal. I was with a small public safety department for 14 years where I was on the law enforcement side, and we also did fire, and I was a firefighter for them as well for a number of years. So cool to have a law enforcement brother here on the call too. So really good stuff, guys. I've got just a little bit of brief background. This really was an ask me anything format for this thing today, but I just had a couple quick slides I'll run through just to kind of go through a couple background things. And this came from a presentation I did a couple days ago on 3 critical things for raising capital. So I might even kind of run through this. This is a 20-minute presentation. I can probably do in about 3 minutes. But what I really want to do by doing this is it kind of stimulates some conversation. Maybe you think of a question or something will come up through this. It'll spark you to say like, hey, I want to ask about that. Or if nothing else, it gives you time to think of like, oh, I better think of a question because this is an Ask Me Anything format. So we don't want to just sit here and look at each other. Just a brief bio on me. I've been investing in real estate for 35 years. I started in 1989 when like Al Gore invented the internet. If anybody remembers that joke. But since then, I've bought over 4,000 multifamily units, all of which, well, not all of which, most of which were syndicated. Some of the early ones I bought on my own. I also have bought over 700 single family homes. Most of those were at the foreclosure auction on the courthouse steps, where I would buy it, renovate it, and resell it, deal with the eviction of the former owner, kind of all that stuff. Also held about 120 of them that I bought at the very bottom of the market in the San Francisco Bay Area. It was perfect timing, kind of 2010 era, and sold all that stuff about 5 or 6 years later for like 2.5x what we bought it for. So that was kind of a fun, kind of like long-term fix and flip trade. So all this amounts to about 850 million in real estate, funded by 2,500 or so passive investors who've invested about 350 million into 40 different, 40, I think we're up to like 42 or 46 or something like that, different offerings now. 7 years ago, I started up a bridge lending company, making bridge loans to mostly fix and flip investors. The 5 years that we owned that company, we did $2 billion in volume. 1 billion of that was actually in our 5th year. And that got us noticed, and we got an offer from a publicly traded company that we couldn't refuse, and sold that company, and that threw me into kind of like a semi-retirement. But the other thing that kind of threw me into semi-retirement is I saw that the market was changing in 2021 and 22, and I sold 3/4 of my multifamily inventory in 21 and 22, which turned out to be right exactly at the peak of the market. And when I sold the lending company, we closed in July of 22, which also was the exact peak of the market. So I got really lucky in timing both of those exits fairly well. I'm also on the other side of the table as an LP investor, not only in real estate syndications, but also in pharmaceuticals, oil and gas, agriculture, lending, a variety of different ventures inside and outside of real estate. So I get a bit of a perspective from both sides of the industry, and also an interesting perspective on other industries. A couple of you mentioned the book, The Hands-Off Investor. I saw at least one person had it there with them. That's really cool. Thank you for taking the time to read it. I hope it was helpful to you. My goal in writing this book was to educate passive investors on kind of the do's and don'ts of investing in real estate syndications primarily, but you could apply this advice to just about any asset class. I was sparked in part to write this because a friend of mine that I worked with when I was 16 years old lost her entire life savings investing in a passive real estate syndication. And I just thought if there was anything I could do to prevent that from happening to one person, then all the efforts that went into writing this book would have been totally worth it. Uh, and raising capital, as you know, is tough. It's not for the faint of heart, for sure. And those of you who are on either side of the table as an LP investor investing, you kind of feel like this cat on my screen where you just don't know, are any of these investments going to come after you, or are they going to be successful or not? So I think raising capital or investing capital, either side of the fence, really comes down to one primary concept, and that concept is trust. Trust comes in a variety of formats. One is you have to trust the business or the investment. So if we're talking about real estate syndication, if you're talking to someone that wants to invest and you say, here, I got this real estate deal, and they're like, oh, I hate real estate. It's like a falling knife. The market's terrible. Real estate's toxic, all those different things. You're never going to get them to invest with you. And some people try to overcome objections and educate and do all those kinds of things, but it's a long road to hoe to get there, to get people to change their mind about how they feel about a business in general. So you can save a ton of time by recruiting investors that already trust the business that you're in. So if you're in real estate and you go find people who already like real estate, you're already a third of the way there without even doing anything. And kind of same goes for a passive investor. If you're only going to invest in industries that you really believe in. Trust is another thing. The second kind of trust circle you have to close is they have to trust you as an operator who's raising money. If the investors don't trust you, they're not going to invest with you. And kind of the same should go to you as a passive investor. If you don't trust the operator, don't make the investment, because really the operator is, in my view, the most important element of your passive investing journey. I think maybe if I were to think of the second most important element, it would probably be the capital structure. I think people are seeing that now with the debt and equity structures that were put in place by a lot of groups in kind of the heat of the market when we were peaking out a couple of years ago. Some of those capital structures are coming back to cause a lot of problems. I think I heard I think it was Anthony mentioned a capital call. So, that's one of the things that's going to lead to a capital call is the capital structure. Trusting you as an operator comes down to experience, track record, and character. Character is really kind of hard to define. So it's a get to know you kind of a thing. You want to get to know your investors. Your investors want to get to know you. As a passive investor, you want to get to know the people you're considering investing with. When you're thinking about the team that you're going to invest with, I think, experience matters a lot. Also, track record matters a lot, and character, again, matters a ton. Now, one thing that's kind of new I'm talking about on track record lately, people used to always think of track record as like, what returns have you produced? Let me see what your IRRs have been. How much money have you made? What did you buy for? What did you sell for? How much did it cost you to get there, kind of stuff. But here's another element of track record. As a passive investor, you want to be thinking about nowadays, and that is, what does your current portfolio look like? Do you have a bunch of stuff that you bought in 21 and 22 that's financed with bridge debt, with maturities this year and next year, with high loan to value ratios, with values that have fallen where the asset value is less than the loan amount? Because if that's the case, that sponsor that you're considering investing with is going to be spending an inordinate amount of their time swatting flies, dealing with all the stuff that's happening in their existing portfolio. So kind of having a lack of these legacy issues is going to open up their mind and their calendar to focus on the investment you're making with them. Finally, you have to trust the deal. You've got to trust the real estate, the neighborhood, the comps, if they show you any. You got to trust the underwriting, the debt structure, the equity structure, and the fee and promote structure. If you can't trust the deal, then it's really hard to make those investments. And as a sponsor, if you can't get your investors to trust the deal, they're not going to make that investment with you. So if you put all this together, kind of like trusting the industry, trusting the team, and trusting the deal is really what it comes down to for this matchmaking process to happen for sponsors, GPs to get capital, and for passive investors to invest capital. Both sides want the same thing. You want to be able to show that you're worthy of that trust, and the investors are going to be looking for holes into why they shouldn't trust you. Everybody knows where to get the book, biggerpockets.com/syndication book if you don't have it already. And that was all kind of like the prepared stuff that I had for you guys. I think, from here, we can launch back into the Ask Me Anything format. And, you guys kind of know the rest of the story the rest of my story, I think.
That was great. Yeah, I mean, anyone that wants to jump in, just go right ahead. I'll take the first one. That way people can think of some questions. But you brought up a good point about especially timing, where, a lot of us that invest in some of for instance, my first deals were in 2020. So I've had a few come full cycle, which also brings an opportunity what do I do with this now? So I find myself at that process again of looking at potentially new opportunities. So with in mind, looking at diversification within multifamily, there are also other asset classes within commercial real estate, not just multifamily. But, how do you look at vetting out sponsors in those deals? Are they the same core principles?
Yeah, that's the beauty of this, of that framework that I just showed you is it's agnostic to the asset class. I mean, those things really apply to capital matchmaking in any industry. I mean, if you just invented a widget and you want to go do a series seed round or an angel round, the same principles will apply. Angel investors would want to trust, like, you made a medical device. Well, they don't know anything about medical devices. They're not going to invest. They want to trust that you know what you're doing. Like, oh, you've got this great medical resume, and that's how you were able to create this new widget. And they want to trust that, the deal structure is right so that they're going to get their investment back and make a profit. So it really doesn't matter at all. Any type of asset, it's going to apply. Now, how do you look at different asset classes to invest in today? I like to talk about market cycles of, like, a lot of people think of a market cycle in a very simple sense where the market's low and then it goes up and then it bell curves and then it starts to come down. And that's the so-called market cycle. So, and that applies to all of real estate. But in fact, it doesn't really work that way at all. In fact, what happens in real estate is you have all these different, like, it's called a sine wave. It's a wave that kind of goes like this, where you have the up and the down. Real estate is like a bunch of different sine waves at the same time on the same screen, all in different phases with one another and all at different amplitudes. So in kind of like simplest terms, you could have multifamily in like hyperdrive at kind of like market peak. At the same time, you could have, say, for example, industrial could be at a market bottom. And while that's happening, hotels are climbing and offices declining. You can have all these things happening at the same time. And I think we're seeing that right now. And it's really, really pronounced right now when you look at office properties. Office is like way down in the toilet. I'm seeing some trades that are happening at 20% of the prior trade value. So that's an 80% decline in value on the real estate. There was a property I just saw the other day that traded hands for 50% of the loan amount, which when the loan was made was like a 70 or 80% LTV. So when you think about what that price was relative to its previous trade value, it was really, really low. Back in 2008 and 9, I was buying single family homes at the courthouse steps. I would research the prices that were paid in previous trades. So I would go back and research the transaction history for that house I just bought. And I was finding that the prices that I was paying were prices that were paid for that same property in the 1980s. So literally setting the clock back almost 30 years. But at that same moment in time, other classes of real estate weren't necessarily suffering in the same way. Office wasn't as bad off. So real estate's always got something going on. And there's always a needle in a haystack. You just have to try to find it. Right now, I think you've got Midwest still has relatively strong rent growth, like above the national average for what that's worth. I mean, when I say relatively strong, we're talking 3%, 3.5%. And when you go like, well, geez, Phoenix was 40, that three is nothing. Well, that's not happening again. But so that might be a place to look for multifamilies in a place where there is rent growth. You might shift asset classes and look at industrial. A lot of people were looking at self-storage a couple of years ago. Now self-storage, I think, is on the decline. So, that decision might come back to bite some people. Single family homes are holding up well. There's nothing wrong with investing in single family homes. Fix and flip is something you can do in absolutely any climate. The best period I had for fix and flip was in the worst real estate market in 08, 9, 10, and 11. My business grew more than it ever had. Where else can you find stuff? People are looking at hotel. There's some hotel trades that were just kind of coming out of like the COVID decline when the values went down, and they're starting to come back up. Yeah, average daily rates are coming up. Rev per available room in some markets are coming up. And then you can also look at different places. Where is tourism on the rise? That might be a place for hotel. Where are people moving to, but nobody's building any multifamily? That would be a place to think of. So it's always just a matter of trying to find, where you've got the right market conditions and what asset class is working and where and what strategy.
I had a question, Brian, and thanks for coming to speak to us today. Do you find that in the current environment that we're in, especially with rates as they are, that a lot of that passive money is being parked into loans, bridge financing, performing loans, non-performing loans, since those returns are providing some equity-like returns in the low teens compared to a few years ago where multifamily was a lot more hot?
Excellent question. And yes, I do. I think a lot of capital is being parked. I know mine is. I'm loving earning 5.5% in a money market where I have zero risk. I can get my money out on like a few seconds notice, for sure. And even other industries, right? So I've invested in several oil and gas partnerships. That was something I wouldn't have even thought about doing 5 years ago. So, people I think are shifting into other assets. I've actually been participating a lot in just retail stock investments, Tesla, Nvidia, those things that have been doing remarkably well. Uh, there's money to be made a lot of ways. Real estate syndication isn't the only way to make money, and syndicators tend to think it is. They want to tell people like this is the place to put your money, and that's not true. There's so many different avenues for you to make investments. Syndication is only one of them, and it doesn't always work that great. I don't personally right now. I'm not buying. I haven't bought a multifamily property in 2.5 years, and I would be surprised if I buy anything in the next 12 months. And right now, I'm just like, as you said, parking real estate debt. I'm invested heavily in real estate debt, as you talked about. That's a really good place to be right now. And I think there's a couple of reasons for it. I think in part, it's the returns are good. And another part is risk mitigation is really top of mind, especially right now when no one really knows the true direction of income producing real estate, especially when you can't even figure out the direction of the cost of capital. And everybody wants to say, oh, rates are going to come down. How many times last year did you hear that rates were going to come down this year? And when were they going to start? They were going to come down 4 times, and it was going to start in like March, right? And there was all that. So everybody thought they knew the direction of cost of capital, and then they got stomped. And maybe now, I don't know if we can all agree that no one really knows. I mean, would any of you like be completely shocked if at the next Fed meeting they raised it a quarter? I wouldn't be, because I feel like the Fed is trying to, use the wrong tool for the job, and it's not working, and that makes them unpredictable. And an unpredictable cost of capital means there's unpredictable investment results. But one thing that's predictable, at least for now, is some of these other investment alternatives.
Following on that, Brian, so maybe when capital is a little more predictable, but what other signs would you be looking for, maybe, over the course of that next year, to say, hey, maybe now is a good time to get back into multifamily or whatever that is for you?
Yeah, one of my favorite indicators is what I call my psychological index. When the more I hear people hate real estate, the more interested I get. And the more I hear people love it, the more ready I am to bail. And so I'm looking for the opposite of what I saw in 21. Because in 21, everybody wanted multifamily. Everybody. And I mean, like, I'd get multiple unsolicited offers on our properties almost every day. And finally, when I decided to take one of them, and then put others on the market to see what would happen, we were getting dozens of offers on every property, way over what we thought we would get, with multiple 6-figure, 7-figure hard earnest money deposits upon signing of the contract. That kind of what I call irrational exuberance. That's when you know there's a market top. People talk about, rent growth and economic this and indicator that. To me, it's when everyone is bailing in, that's the market top. And now when everybody bails out, I think that's when I'll start to see a market bottom. And so one thing that people quote to me all the time is they say, like, oh, but Warren Buffett says, be greedy when others are fearful, and fearful when others are greedy. And now people are fearful, so I want to be greedy. That means this is the time. And here's my feeling on that. I feel that buyers are fearful, and they are finding places to put their money, like to this point just a moment ago, money market accounts, real estate debt, other asset classes. Buyers are fearful because they don't know what direction prices are headed. But sellers aren't really fearful, because sellers are like, yeah, we still have a little bit of cash. We're making our payments. Occupancies are holding up. Rent growth is going to come back soon. I only have to buy this one more rate cap, and after that, the other rate caps are going to be way cheaper because the Fed says it's going to lower 4 times, stuff like that. They're not really all that fearful. But they're gonna get fearful, when the owners start running out of cash, when they realize that the interest rate isn't coming down anytime soon, when their maturity date comes up and their lender says, yeah, we're not giving you an extension. When that stuff starts happening, then owners who will become sellers are going to be fearful. And when that happens, that's when I think we're going to see more price discovery. And that's when I think we're going to see a little bit more clear definition that we've reached a bottom. And I haven't seen that happen just yet.
Any more questions?
Hey,
Come on,
Brian.
guys.
Oh, yeah, I can ask one opinion on. We talked about alternative investments other than multifamily. What are your views on notes not investing in residential? What are the pros and cons of that?
Are you talking single family?
Yeah, single family land or mobile home.
Well, to start with, notes or loans are on the lowest rung of the capital stack. And that is a really feel good place to be right now. I mean, when you think about being at 70% of the capital stack or 65% of the capital stack versus 100%, which is where you are as an equity investor, it feels good because you know that if the value comes down 20, 30, 35%, you haven't impaired any of your principal. And that's why I like being in real estate loans right now is, the market can go down and we won't lose anything. Now, having said that, you still have to do it the right way. Where you get principal impairment is when you're making second loans, making loans to inexperienced or non-credit-worthy borrowers, making loans on properties that you can't dispose of or that have no viable exit. Because then even if you have to foreclose, you've got nowhere to go. So be really careful. I would say land scares the crap out of me. I wouldn't want to ever loan on land. It's very difficult to get rid of. Mobile homes, I wouldn't really like it. When you do residential to consumers, the regulatory framework is very complicated. I think, who was it? Ahmed is a former banker. I'm sure he could do a whole presentation on the complexities of making loans to consumers. So if I were you, I would stay out of that. I told you guys that I made $2 billion in loans in our real estate company over a 5-year period. Not a dollar of that was a consumer loan. Every bit of it was to a professional real estate investor who had at least 3 real estate investments under their belt, had at least 6 months principal and interest sitting in cash in the bank, had at least a 650 or 680, I forget, FICO, didn't have any bankruptcies in the last 7 years. And I like the real estate. And if we took over the real estate, we would have a way to get rid of it. So I would suggest, oh, and by the way, none of those could be owner occupied. They all had to sign non-occupancy affidavits. They all had to be for a fix and flip purpose or construction or rental. We could not and would not make loans to anybody that was going to live in the property. So I like the lending space if you're careful about doing it right. Now, Ahmed, do you have anything to add to that I might have missed?
You are right on the money, actually. It's just the banks right now being extra critical about giving loans, and everything you mentioned, regarding who you should give the loan to is very, very critical in lending environments, and specifically nowadays. So you're right on the money, man.
Good stuff. Right on. Randeep, hopefully that answered your question.
Yeah, it did. Would you also talk about other asset classes like self-storage, mobile home parks, RV parks? What are your views on these asset classes?
So self-storage is a very popular asset class over the last few quarters because a lot of multifamily investors who couldn't do multifamily deals because the multifamily business sucks right now, Ryan, okay, are buying self-storage, looking for easy to run income properties. They're not as easy as you think. I built a self-storage facility from the ground up, and that meant leasing it up from the very first unit to the 302nd unit. And it was tough, I've got to tell you. And it's a little bit management intensive from the standpoint that you've got, employees and a staff, just like you would in multifamily. And you can certainly hire a management company to deal with that for you. But what I think is probably the biggest risk in self-storage right now is that self-storage rents have been declining, recently, and that makes it tough. So I suppose if you do a really good study about the market that you're in, remember what I was talking about a few minutes ago about how markets, even in the same asset class, can be in totally different phases in different parts of the country. If you can find a spot where self-storage is really working right now, then that could be a good investment. And it's kind of easier to transition into than, say, for example, hotels or maybe retail and industrial. Retail is the biggest challenge you have there is vacancy. If you get a vacancy in your retail space, you could almost go your entire career before you refill it. In some cases, I mean, have you ever driven by a vacant retail space that's been vacant for like a decade? Kind of the same thing in office. The office suite, 2 doors down from mine. I'm in a Class A office building, and the office suite 2 doors down from mine has been vacant since about 5 years before I moved into my office, and I've been in there 10 years. So it's like I'm in 2,000 square feet, and that office is 7,000 square feet. So imagine having 7,000 square feet vacant for 15 years. And there's like no hope of it really filling anytime soon. So office, I mean, even in the best of times, office is a bit of a challenge. It's also very capital intensive because you have to do all the tenant improvements. Hospitality is an interesting business and a good one, but it's very like you really have to know what you're doing. I actually built a lakefront resort motel. And I mean, although I've spent my time all the way down to selecting like the shampoos that go in the bathroom. I mean, there's so much to learn that it's a massive time suck. So, if you buy a flagged hotel and have a management company run it for you, then it's a little bit more like a capital investment, probably a little bit easier. Mobile home parks, certainly they're great in some states. I sure as hell wouldn't want to own a mobile home park in California. It's like the rent control that you have here is just off the charts, makes it damn near impossible. But in some places, mobile home parks really work. One thing that's really good about mobile home parks is the tenant base is pretty sticky, because it costs a lot of money to tow that thing out of there if they don't want to stay. So they can be a little bit recession resistant from the standpoint that you've got a lot of workforce housing type people that are in there. But I'll tell you, if you don't have any diversity in your tenant base, that could be a little bit of a challenge, because if everybody's kind of in the same boat and whatever industry it is that they're in suffers and all your tenants start losing their jobs at the same time, that could be an issue. So just pay real close attention to the diversity of the diversification of the resident profile. So as with any real estate asset class, nothing is perfect. Everything has its risks and its rewards. I mean, multi is a great asset class most of the time. This just happens to be one of those times where it's not all that great. But that will change.
Hey, Brian, quick question. Appreciate you alluding to the multifamily investments. And I think you, alongside with many investors who have syndicated and owned and operated and maybe built from the ground up, talk about the real big, investment opportunities in the very sought after, locations like the Texas of the world and the Southeast, right? I, however, maybe Chris can back me up on this, found there's smaller quasi multifamily between the 4 and the 10, 20 units kind of thing that are being run by, older mom and pop shops who have done with the freaking eviction moratorium of, COVID regulations in upstate New York, and they're like, throwing the towel. They're like giving up, and we were able to. I personally was able to pick some units at $50,000 a unit, $60,000 a unit. in very highly demanded rental locations and was able to bring 50% markup on some units. You know what I'm saying? This is in recent months, you know? So I guess I'm trying to understand your concept of not investing in multifamily. We do see some opportunities in the market, even though in upstate New York, nobody wants to invest in New York. We like it. I like it personally. I find ways to work around it, especially like investing in 5 units that are 100% vacant. Then I have to evict anybody, right? It's an opportunity for me. I got it for $60,000 for a unit, you know? So what are your thoughts about that? And also, have you ever heard some people who are like investing in, let's say, short-term rental and not sought after locations like California and Hawaii and all these places, for example, Puerto Rico? Have you heard anything about Puerto Rico and investment in Puerto Rico?
Yeah, that's a really great point, Ahmed. I'm glad you brought that up because I was doing a presentation at a conference about 10 months ago, and somebody asked me, like, where is the opportunity in multifamily right now? And that was my exact answer. I said the opportunity in multi is in the small stuff, because all the syndicators are focused on the bigger stuff, call it 100 units and up. There's a lot of competition in that space. But the other thing about that 100 units and up space is all the owners are relatively sophisticated. There's no such thing as the tired landlord in 100-unit apartment buildings. That's a total unicorn. I mean, you'll never find that because that's their business. They're professionally involved in that industry. They wouldn't have bought 100-unit buildings if they were going to get tired of be the tired landlord. But in those 4, 5, 10, 20, 30, 50, that space, those property sizes, you will absolutely find needles in haystacks. You just have to look hard enough. And there's a great opportunity also as an arbitrage play. If you can buy something really cheaply, then kind of like the rent growth doesn't matter, right? It doesn't matter if the rent growth is 0 if you're buying something for next to nothing. Great example is I bought this. I had this one property in California that I bought at the foreclosure sale and fixed it up and resold it. The guy that bought it from me split it into a duplex, then split the lot and built 2 more units on the second lot and made it into 4 units. And so great investment. I think he bought it from me for like, I don't know, 200 grand. And then probably spent another 200 grand adding on the 2 brand new duplex units on the lot next door. So he's probably into it for, $300,000 or $400,000. But lo and behold, he doesn't make his mortgage payments. And a couple of years later, I bought that property again at the foreclosure sale for the second time. But this time I paid $61,000 for all 4 units. And did I care that it was in a little tiny town, on I-5 in California that, when you can, and by the way, those units rent for $700 a month. And so to buy 4 units rented that I can rent for $700 a month for $61,000 that I didn't even have to fix up because they were literally just redone. And one of them was brand new construction. It doesn't matter if there's never $1 of rent growth. And I've never in my career of 786 properties ever gotten a deal that good. And there's needles in haystacks and you'll find them and they might even come up when you're not even looking. So 100% agree with you on that point. As to short-term rentals, I'll tell you why they scare me. They scare me because regulatory issues can really be painful. Ask short-term rental owners in Hawaii. They're coming up with all these new short-term rental regulations now. I know like there's a lot of cities in California that have banned them. So you can say, oh, I bought one in a place that doesn't have any regulation, but that doesn't mean that the city council won't show up next week and vote you out. So be really careful. I think if you can buy a short-term rental that at a price where you could resell it as a single family home, or you could rent it out as a long-term rental and the numbers work, and the short-term rental delta is gravy, fine. But if you're looking at it like, hey, I can rent this thing out for like, $500 a night. I can pay $1 million for this property that otherwise would be worth 400,000 because of that income. That would be a big mistake. I don't know anything about Puerto Rico, so I can't help you on that question. But I'm not opposed to like these kind of like needle and haystack investments in out of the way areas, because sometimes you can find incredible deals. And that one I gave you was an example of an absolutely incredible deal in a city that would be on no one's radar.
Great answer. And I'm going to pin you to that because I'm going to talk to you about borrowing some money from you in the needle and haystack because I've been looking for private money for the past freaking month. And
it's really hard. I didn't say that I would invest in it, but I would say that if I'm the operator, I would certainly buy it. But I get it. It's, as a banker, right? So, I mean, what's the old joke about a banker is that they'll loan you their umbrella when it's sunny outside. Yeah, they loan you their umbrella when it's sunny outside, and they ask for it back when it starts to rain. And and they don't want to loan in like out of the way areas or off the wall properties, because if they take it back, they don't want to fool with it. So I get why it's been tough to find financing for it.
But with a tougher environment right now, and Chris can back me up on this, and I'm sorry for taking so much time to everybody here. The private lenders who used to be like, bridge lending, right? Used to be at the 8 and 9 and 10%, now at the 13%.
Yeah.
With 2 to 3 points. And oftentimes they're scared to look at markets where I know they're growing markets close to Albany, but they look at some system online, they say, oh, it's a rural place. We're not going to be lending to you guys. Dude, the demand is there, have some proof. I got everything to show you. They're not flexible. So from a banker's standpoint, I understand where they're coming from to protect the bank. You see what I'm saying? But at the same time, if I think private lending, maybe I should talk to someone who is acclimated to that environment. So kind of like, let's say, talking to a small community bank within a particular area than talking to JP Morgan, right? So
yeah,
I haven't really particularly found that particular lender or investor want to jump on such a deal.
And that's an interesting point. So as a lender, you have a finite amount of capital that you can place. And there's so much demand for it that you don't have to do out of the box stuff, and you still allocate all of your capital, right? So the out of the box stuff gets funded last. What I would recommend to you, and this worked for me a lot in the past, is I would go directly to private individuals for loans like that and cut out the bridge lender, private money, middleman, broker who wants to say no to everything. Even if that meant that you had to go to a couple people to put it all together. And I have done that in the past where I would just, I would call up a couple people, hey, can you, I need to give this $300,000 loan. Would you do it, or would you do half? And then so-and-so will do the other half kind of thing. You might just have to piece it together yourself.
And that's what we're looking at right now, looking at possibly borrowing money from local banks, like small community banks, who got a little bit more flexibility, even to refinance within 2 years, to be honest with you, which is awesome. And hopefully we can raise capital from private individuals to come up with the down payment and the closing costs and everything,
That makes sense.
So let me jump in, Brian, because we're looking at the time at 8:25. So you got 5 more minutes in here, and I want to circle back real quick on the passive investing part of this. And I think it was Anthony that mentioned about having a capital call. I think in your book you spent a good amount of time talking about what happens once you already invest and you're in the deal, which I think is great. So much is spent on, what to get into, but you're already in it. How do sponsors communicate? So what about if you're in a situation, distributions have paused, things are, you're not really quite sure what's going on. I think somebody said it's an LP is like being on a plane, so, you can't jump off, right? You're in it and you get that capital call, and there's an opportunity to whether choose to dilute yourself or you go in. What are some of the, I guess ideas of, you don't want to throw bad money out, keep throwing it back. Like what do you do? And, any tips in that situation?
Yeah, this is a topic that's going to be talked about a lot because I think probably the majority of sponsors that bought anything in the last 4 years are going to have a capital call, or will certainly at least be contemplating one. So the decision on whether to fund or not is actually an easier decision to make when the thing is like really in the toilet. Like if they say like, look, if we sell today, you lose 100% of your money. But if you put in an additional 20%, we can save the deal. The calculation is actually actually a really good return on investment. If you can put in, say you put in 100 grand, and you can put in 20 grand and only get your 100 grand plus the 20 back in 5 years. That's like a 20% return on your money on that 20 grand, because you have to assume the 100 is already gone, right? The calculation gets more difficult when you get a partial return to cap. Like say, well, if we sell now, you can get half your money back. But if we sell in 5 years with a 20% capital call, you can get all your money back. Well, now you have to think about, well, what could I have earned on the half of my money that I get back now if we just sell and get out of it? You know, you have to factor that into the equation, and whether or not your capital call funds are a good investment becomes a little bit more difficult to quantify. So I'll start with that. But when it comes to whether or not the investment is going to be successful, here's my thoughts. If there is a loan maturity anytime in the next 4 years, I think the chances of bailing that deal out with a capital call go down dramatically, because the real problem is the loan maturity. Even if the cash flow is compromised and that's an immediate problem, the maturity is going to be a major problem. So if you don't have a loan maturity, then I think the chances of survival with a capital call are much, much greater. The other thing I would think about is how much time do you get by making the capital call, by fulfilling the capital call? Yeah, I've seen one recently being talked about where the sponsor is doing a 20% capital call for the purpose of funding another year's rate cap and some other stuff, and basically saying that it'll buy us another year, and then by then the market will be better and we'll sell, and you know, we'll get all of our money back. And I don't buy it. I think that deal is going to be a zero. The whole thing is going to implode. 1 year is not enough time. If a capital call is only getting you a year, it's not going to do you any good. I think you're throwing good money after bad. Chances are probably greater than not that you'll lose not only your initial investment, but the capital call money. Now, if the sponsor comes back and says, you know, we're going to do a 20% capital call, and even if the market doesn't get any better, this capital call will get us by for 6 years, I would say you probably stand a chance better than not that it's going to be successful in the long run. Because everybody knows, you guys have all been in real estate long enough to know that after 7 years, the value of that property and the rents on that property are going to look a lot different. It always does. 7 years is a long time for things to turn around. So I think it really depends on how much time that capital call gets you and whether or not you actually have that time. Because if you have a loan maturity, you don't really have that time. You have until the time the loan matures.
Awesome. So yeah, I think 8:30, we're right at the vast. I don't know if you want to take one last question and then we wrap it up.
Happy to.
All right. Let's see if anyone else has one.
Can I go?
I think you've done your questions already.
Okay, so I'm done. Okay. No more questions. Brian.
Let's get someone other than Ahmed. All right.
They're not aggressive enough.
I'll take one.
There you go.
Brian, I mean, you've spoken a lot about, you know, the various things that you think are, you know, good to be in at the moment, maybe not so good to be in the moment. Any assets or asset classes that you are consistently in, no matter what the market environment is, and if so, why?
I have not. I've tend to move around. I want the momentum to be on my side, and I've moved around. Even within real estate, I was doing single family, and then I was doing self-storage, and then I was doing single family rentals when before it was only flips, and then it was flips and not rentals, and then in multifamily value add. Now I'm more kind of in the multifamily class A longer term, buy and midterm hold space. But not yet, because the market isn't ready for that yet. So I'm kind of in this no man's land. I mean, I tell kind of the joke I tell people is that there's a time to buy, there's a time to sell, and there's a time to sit on the beach. And right now, this is the time to sit on the beach, and that's what I'm doing until it's time to buy again. Keep your dry powder ready, and time value of money is meaningful. I mean, invest in something now and then watch the market decline further and not recover for X number of years. Gosh, I just think you can earn a return somewhere else while all that plays out, and then jump back on when it's starting to climb again. So no, I don't think, I'm not a consistent throw it there and forget it. I guess the only thing I've ever done that with is Amazon and Apple stock that I bought 20 years ago. And I'm really happy that I've never looked at it again. But that's about the only thing.
Good to know.
Well, thank you everyone for the questions, and Brian, thank you so much for coming on. I appreciate it. I will have a recording out of this, and if you want to have any final words for everybody, thank you again, Brian.
Yeah, final words. Great questions, guys. This is a really intelligent discussion. I love the idea of smaller multi if you want to find needles in haystacks. If you guys really want to work hard, you can find opportunity anywhere, at any time. There's arbitrage plays are always out there. They're just sometimes take a lot of searching. So good luck. And hopefully you guys find that right needle in haystack and blow it out of the park.